Larry and Brenda from Michigan did everything right. They saved for 30 years. They maxed out their 401k. They retired with $400,000 in a plan. Then Larry found an ETF paying 38% a year. 38%. He moved half their savings into it the same week. 6 months later, their account was down $42,000. But here's the strangest part. They were still getting those big monthly checks. The income looked amazing. The balance did not. What happened to Larry and Brenda happens to thousands of retirees every year, and most of them never figure out why. By the end of this video, you'll know exactly why some high-yield ETFs quietly drain your savings, while others actually grow your wealth. I'm going to run 5 popular ETFs through a retirement scorecard, and only one of them passes. The part most people miss is this. The headline yield number is not the number that matters. There's a different number buried in the fund data, and once you see it, you'll never look at a high-yield ETF the same way again. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So now you know Larry and Brenda's mistake, but here's the real question. How do you tell the difference between an ETF that pays real income and one that's just handing your own money back? That's exactly what the scorecard answers. Let me show you. The Retiree's Scorecard. 5 numbers that tell the truth. Smart retirees don't chase yield. They check 5 numbers before buying any high-yield ETF. Here they are. Number 1. NAV trend since inception. NAV stands for net asset value. It's the actual price of one share of the fund. If the NAV is dropping over time, the fund is shrinking, even if the checks keep coming. Number 2. Total return versus headline yield. Total return counts everything, the income you received plus the change in your share price. A fund can advertise a 30% yield, but if the share price dropped 25%, your real return is much smaller than you think. Number 3, return of capital percentage. This is the big one. Return of capital means the fund is not paying you from profits, it's paying you with your own invested money. It's like taking a 20 from your wallet, putting it in your pocket and calling it a paycheck. Number 4, expense ratio. This is the annual fee the fund charges. Higher fees eat into your real return every single year. It adds up. Number 5, tax treatment. Some funds use a special option structure that gets taxed at lower rates. Others create a tax mess that can even raise your Medicare premiums. For retirees, this one matters more than most people realize. So now you have the 5 numbers. Let's apply them. We'll start with the 2 ETFs built on tech stocks, and one of them is going to score very differently than you'd expect. The tech income plays, QQQI versus MAGY. First up, QQQI, the NEOS NASDAQ 100 High Income ETF. This fund holds the top 100 tech and growth companies, Apple, Nvidia, Amazon, Microsoft. Then it sells options on those stocks to generate monthly income. QQQI pays about 14% a year, not the flashiest number on this list, but here's what matters. Since it launched in January 2024, the share price has actually gone up. It started at $50, today it trades near $54.50. That means your principal grew while you collected income. 1-year total return, 29%. And here's a tax bonus most people don't know about. QQQI uses index options that qualify for a special tax rule. 60% of the gains are taxed at long-term capital gains rates, even if you held the fund for just 1 day. That can save a retiree thousands of dollars compared to a fund taxed entirely as ordinary income. Now let's compare that to MAGY, the Roundhill Magnificent 7 Covered Call ETF. MAGY holds only 7 stocks: Microsoft, Meta, Amazon, Nvidia, Apple, Tesla, and Google. Then it writes weekly options to produce a massive yield of about 38%. Sounds incredible, right? But the scorecard tells a different story. Since launching in April 2025, MAGY's share price has dropped from $50 to about $46. That's an 8% decline in roughly 1 year. Its options do not qualify for the special tax treatment that QQQI gets, and the expense ratio is higher at 0.99%. So QQQI passes all 5 criteria. MAGY passes 1, gets caution on 3, and fails 2. MAGY isn't a terrible fund, but it's a much riskier income tool than the yield alone suggests. So the tech side has a clear winner. But what about the 3 crypto income ETFs that promise 24 to 42% yields? That's where this gets uncomfortable. The crypto income plays: BTCI, BITY, and BAGY. Let me be direct. What I'm about to show you is the part of the high-yield ETF world that nobody wants to talk about on YouTube because it doesn't get clicks, but it could save your retirement. We're looking at 3 funds: BTCI from Neos, yielding about 26%, BITY from Amplify, yielding about 24 to 28%, and BAGY, also from Amplify, yielding roughly 38 to 42%. All 3 give you Bitcoin exposure and sell options on it to generate income. The concept sounds exciting. Bitcoin's volatility creates huge option premiums. Those premiums become your monthly checks. But here's what the scorecard reveals. BTCI launched at $50 per share. Today, it trades near 36. That's a 28% drop in your principal. Its 1-year total return, including every distribution, is negative 13%. You lost money even after collecting all that income. BITY is worse. It dropped from $50 to about $34, a 32% decline, and 95 to 97% of its distributions are classified as return of capital. That means for every dollar of income you receive, roughly 96 cents is just your own money coming back to you, while your investment shrank. Before I show you the tax trap that makes this even worse, I want to hear from you. Drop a comment right now. Have you ever owned a high-yield ETF that looked great on paper but quietly lost value? I read every single comment. Now, here's the part almost nobody talks about, and it can cost retirees thousands of dollars a year even if they pick the right fund. It's the tax and Medicare trap hiding inside every one of these.
The tax and Medicare trap nobody mentions. Here's the myth. Return of capital is free money. You get a check, you don't pay tax on it. Sounds like a dream. Here's the truth. Return of capital reduces your cost basis. When your cost basis hits 0, every dollar after that becomes a taxable capital gain. And when you eventually sell the fund, you owe taxes on every dollar of ROC you ever received. It's not free. It's a tax bill you haven't received yet. In 2026, the standard Medicare Part B premium is $203 a month. But if your income crosses $109,000 as a single filer or $218,000 as a married couple, you hit what's called an IRMA surcharge. That means your premium jumps by $81 a month just for going $1 over the line. Distributions from these ETFs that are taxed as ordinary income count toward that threshold. So a high-yield ETF could push you into a higher Medicare bracket without you even realizing it until the bill arrives 2 years later. The smart move? Hold these funds in a Roth IRA. Inside a Roth, the distributions don't count as taxable income, they don't affect your Medicare premiums, and they don't trigger the IRMA surcharge. If you're going to use any high-yield ETF, the account you hold it in matters just as much as which fund you pick. So now you know the tax side. Let's put it all together. When I stack all 5 ETFs on one scorecard, the verdict is clear, and it's not even close. Which ETFs actually belong in a retirement portfolio? Let me give it to you straight. Out of these 5 high-yield ETFs, only QQQI passes all 5 scorecard criteria. It has positive NAV growth, a strong total return, a reasonable return of capital percentage, a competitive expense ratio, and a tax structure built for retirees. MAGY is a reasonable satellite position, 2 to 5% of your portfolio held inside an IRA. It gives you exposure to the 7 biggest tech companies with weekly income, but understand the trade-off. You're giving up most of the upside those stocks offer. BTCI, BITY, and BAGY do not pass the retirement test. Their yields are largely funded by returning your own principal. Their NAVs are declining, their track records are under 2 years, and 2 of them have total assets under $30 million, which means they could shut down anytime. If you use a crypto income ETF at all, it belongs in a Roth IRA at less than 5% of your total portfolio, and only if you can afford to lose every dollar you put in. A high yield that shrinks your savings isn't income, it's a refund with a thank you note. Remember Larry and Brenda from the beginning? Their mistake wasn't chasing income. Wanting income in retirement is smart. Their mistake was looking at the wrong number.
They saw the yield. They didn't check the NAV. They didn't check the return of capital. They didn't check the total return. One look at the scorecard would have saved them $42,000. You now have that scorecard. Use it every single time before you buy a high-yield ETF. The 5 numbers never lie. If someone you know is looking at high-yield ETFs for retirement income, share this video with them right now. It could save them a real headache. Drop a comment and tell me, which of these 5 ETFs surprised you the most? I want to know. And if you're building retirement income and want to stay ahead of traps like these, subscribe to Golden Goals. I cover everything that protects your income. Next video, I'm breaking down 3 covered call ETFs that actually grew investor wealth over the last 3 years, including one most people have never heard of. You don't want to miss it. I'm Mark, and I'll see you in the next one.